Okay, guys, first things first, does everyone have a newspaper? Okay, good, because we're going to need it for the class. Like Ed said, my name is Ed Ramirez. I am part of the education team with Investors Business Daily. And tonight, above all, is about practicality. It's about knowing how to use this paper in a very straightforward, simple way. Okay? For those of you who've taken this paper, you probably figured out pretty quickly that you don't have to read this paper front to back in order to maximize the information in it. Okay, if you focus on a few key sections, but do it consistently, that's the key, right, is the consistency. I promise you, you will be ahead of most people. Okay? What I don't want to do is add layers of complexity to my routine or to my investing in general. I keep things very simple. Literally, I use this paper, I don't run any screens. Okay, I use the paper to find stocks. And there's a lot of stuff right now going on in the world that could possibly affect our market, right? I mean, Cyprus, Spain, Italy, who knows? We don't necessarily have to worry about that. The only thing we have to worry about is if and when it does affect our market, as long as we're paying attention to price and volume action on the major indexes, that's all we have to worry about. We shouldn't spend our time trying to predict how these things are going to affect the stock market. Instead, as individual investors, we actually have the luxury of being able to react to what's going on. Okay? And that's something that big institutional investors, the guys that control the market, don't have. Okay? So tonight's about practicality. Tonight's about understanding how to use this paper to do a couple of things. Number one, build your watch list. Actually, number one is time the market. Knowing when to be in and out of the market. When to be in cash, when to be in stocks. And number two, understanding how to use this paper to build an actual watch list. Because there's a lot of stocks in here. How do you know which ones that you should focus on? We'll talk about that tonight. Okay? Does that sound good? All right. Okay, so before I get into the paper, I think it's important we understand what we don't do at IBD. And one of the things we don't do at IBD is try to buy low and sell high. You've all heard that term before, right? We're actually trying to buy high and sell even higher. And this concept of trying to buy high and sell higher is completely counterintuitive to the way most people are wired as human beings, right? We're taught from a very young age, go discount shopping, buy what's on sale. But that discount shopper's mentality is a very dangerous mentality to bring into the stock market. Anyone know why trying to buy low and sell high is a much riskier proposition than trying to buy high and sell higher? Anyone take any guesses? Yes, sir.
Low stock is low for a reason.
A low stock is low for a reason. And you don't know where the low is, right? Okay? So what happens is, when a stock is making you lows, what starts to happen is it starts to build what's called overhead supply. Overhead resistance. It's a technical term. Okay? And this is how it works. For example, let's say I bought a stock, doesn't matter which stock, XYZ stock, at $50, obviously hoping that it's going to go up. And maybe the market's bad and the market starts to go down and most stocks will move with the market. So my stock that was trading at $50 over the next few weeks and few months is now trading at $40, right? And there's people who are saying, wow, XYZ used to be 50. I loved it at 50. I really love it at 40. And they're picking up shares at 40, okay? And then me, who bought it at 50, if I'm the typical investor, I'm trying to lower my average cost, so I'm picking up more shares at 40. But then what happens? Well, it continues to roll over. In the next few months, it's now down at $25 a share. And what's happening at 25? The same thing. People are buying, thinking they're getting a discount, and people who own the stock are adding to a losing position. Then it goes down to 15, same thing happens. Eventually it hits $10 a share, and it starts to come up again. Okay? Now what happens when that stock starts to come up? What's the natural inclination of people who've owned it for several months and are at a loss? As soon as that stock shows any signs of life, they become sellers. It's just human nature, right? They want to recoup anything they can from that bad decision. So as soon as that stock hits 10, it starts coming up a little bit, they're selling. And all that selling pressure above that stock makes it very difficult for that stock to gain any real traction. Forget about getting anywhere near its prior highs. Okay? Think of the market as supply and demand. It's all supply and demand. When something is being sold off and supply is flooding the market, in this case shares, what's happening to the price? Right? When there's a supply of anything in the market, 2 months supply, it's going to drop the price. So let's pretend we're that stock at $10, and if we all look up and the ceiling is $50, let's pretend we had a much higher ceiling, okay? Let's say the ceiling's $50. Between me and that ceiling is all the supply that needs to be bought up for me to get anywhere near my previous highs, okay? So it's a very risky proposition to say you're going to try to buy low and sell high. Conversely, when a stock is at a new high, it is actually at its point of least resistance. Right? There is no one who owns that stock above that price who wants to buy, who wants to sell. In fact, most people who own a stock, when it's at a new high, want to hold it, hoping it keeps going even higher. Okay? So this next point is very important, and this is kind of, if we had a mantra at IBD, this would be our mantra. Stocks making new price highs tend to go even higher when it's fueled by institutional buying. Who controls the market? I said it before, right? It's not us. It's the institutions. The big institutional investors, they determine price, they determine leadership. So stocks making new price highs tend to go even higher when it's fueled by institutional buying. And then conversely, stocks making new price lows tend to go even lower. This is why we don't advocate buying on dips. We're trying to buy low and sell high. It's like the guy that goes into the grocery store and he buys the brown bananas because they're on sale, right? You're not buying quality. We want to buy quality. So to illustrate my point, I know I got any IB subscribers in here? I should ask. Yeah. So some of you may know, but this is your basic IB chart. Okay. I'm going to bear with me. I'm going to describe what we're looking at here. This is, you can see the chart's pretty straightforward. It's pretty simple compared to other charts. There are not a whole lot of indicators on this chart. Okay, we got simple price. We got simple volume. We don't really use stochastics, Elliott wave, MACD. Okay, it's just we like to keep things very simple. In fact, I was at a presentation a few months ago, and it was some real advanced technical analysis group down in Dallas. And I was talking about our charts and how we keep things very simple. And the guy in the back raises his hand and says, well, you haven't mentioned Fibonacci. What do you think about Fibonacci? And I said, well, to be honest, I like my Fibonacci with marinara sauce, maybe some garlic bread. Okay? You guys laughed. They didn't laugh. They didn't think it was funny. So we like to keep things very simple, okay? So we got price up here, and we got volume. This happens to be a weekly chart. So each price bar represents 1 week of trading. Let me focus on the price bars for now. So in this case, this is a weekly chart. If it were a daily chart, each price bar would represent 1 day. So you got the high for the... Oh, there we go. Okay, you got the highs for the week. Okay, let's try that again. You got the high for the week, you got the low for the week, and that horizontal tick is the close for the week. If it were a daily chart, it'd just be everything on a daily basis, okay? So the blue bars represent a week where the stock closed higher versus the prior week. The pink bars, or the, as Ed calls them, the fuchsia bars, represent a week where the stock closed lower versus the prior week. Now, you guys see this red bar that runs through, or the red line that runs through the price bars? That's called the 10-week moving average, also known as the 50-day. The reason why we have that 10-week / 50-day moving average on our charts is because we've tested that line going back to 1880. And that line produces the most consistent bounce of any other technical indicator in the market, right? So what does a bounce mean? Well, what happens typically is stocks, leading growth stocks, after making a move to the upside, at some point will start to pull back, and typically they're going to pull back to this 10-week moving average line. And it's at that line where the big institutional owners of that stock will come in and start to support the stock. They'll start to buy up more shares, which causes the support. And when the stock finds support at that line and eventually gets a bounce off that line, that's actually a great time to initiate a position, right? Or if you own the stock, it's a great time to add to your position. So that's that 10-week moving average line.
That's on price, the 10-week moving average is price?
Yeah, the 10-week is a 10-week moving average for price, and it's a simple moving average. Simply, 50 days or 10 weeks divided by all the prices. Okay. Okay. Now, along with the 50-day, we also have the 200-day, also known as the 40-week, and then we have this RS line here, this blue squiggly line. That's called the relative strength line. And it's a little bit, some of you may have heard of the RSI indicator. This is different. This is actually proprietary to IBD. Let me explain what this line does. It's simply a trend line. There's no numerical value to it. It's simply a trend line, and it measures this stock's price performance versus the S&P 500 over the last 12 months. And it puts a little more weight towards the last 3 months of performance. Okay? And it's a trend line. And here's how you use it. When you see the RS line trending up, you know your stock is outperforming the market, okay? And you know you're in a true leader. When you see it trending down, you know it's underperforming. I'm sorry, I say the market, I'm talking about the S&P 500. You know it's underperforming the S&P, and you know you might be in a lagging stock. So keep in mind, it's a relative measurement. So if we're in a correction, let's say the market's in a downtrend, and you have a watch list of stocks that you're watching, and you have some stocks where maybe the market's down 3% for the week, but the stock you're watching is only down 1%, how is that trend line going to look? It's probably going to be pointing up, right? Relative to the S&P, it's showing strength. And then vice versa, when the market's really good, if the S&P is up 3% for the week, but your stock's only up 2%, how is that trend line going to look? It'll probably be pointing down. So it's a really good way, a really quick and easy way to help you determine if you're in a true leading stock or if you're in what we call a laggard, okay, an underperforming stock. Now, down here is volume, okay? And I'm going to talk about volume a lot tonight. Volume equals conviction. Volume is the heartbeat of the stock. Volume is how you know the big guys, the big mutual funds. The Hartford is buying or selling your stock. Okay? And how do we know this? Well, along the volume bars, we have this red line, and that's the 10-week moving average for volume. We have it for price. We also have it for volume. So that 10-week line is the average. Anything that shoots up beyond that line is considered institutional volume or heavy volume. Okay? So now, in this example, as Google is moving up, you notice a lot more blue volume bars. The volume bars, they line up with the price bar. So if the stock is up, the volume bars are going to be blue. So if you see a lot of blue bars as the stock is coming up, that's a sign of accumulation, right? Heavy institutional buying. And then finally, when the stock ultimately starts to break down, you start to see a lot more fuchsia bars, which is a sign of institutional selling. So just by looking at price and volume, you can see what demand is for your stock. Are the big guys selling my stock? Or are they acquiring shares? Are they accumulating shares? Okay? Now, going back to my first slide, which is stocks making new price highs tend to go even higher. This is Google from 2004. And if you guys remember, Google broke out of this little IPO base down here, and if you were lucky enough to catch it, good on you. Most people didn't. But it had a nice price move, okay, for several months. And like all stocks, they eventually go through a consolidation, right? A pullback. for correction. The words consolidation, correction, pullback, chart pattern, pretty much all mean the same thing, okay? There's just a price correction in the stock after the stock has made a major price move. So Google goes through a pullback, right? And it starts to trade sideways. This sideways action is called a consolidation. So some of you may know about IBD's different chart patterns, right? The cup with handle, the flat base, the saucer with handle, the double bottom, or Ed's favorite, the beer mug with handle. Okay? Those are all different types of consolidations. Okay? Don't get so caught up in trying to identify, is that a cup with handle or is that a saucer with handle? Don't get so caught up in that, because what all these chart patterns have in common is they form areas of support and resistance. Support and resistance. That's what it comes down to. Support, resistance. Too many people get caught up in trying to see if that's a cup with handle. Just identify the support resistance, you'll be ahead of most people. Okay? So the support resistance area is actually very, very constructive for a stock. After a stock has gone up, we know it's going to correct. We want to see it go through a consolidation before we buy it. Okay? So in this case, Google went through a consolidation for several months until finally, during this week, it broke through this resistance area accompanied by big volume. Volume is what's going to drive the stock, drive the price of the stock through resistance. Okay? And we want to wait until the stock goes through that resistance before we buy it. We want it to prove to us that it has the ability to break through that resistance, because it may not. You might buy it just short of that resistance area, and you're going to find that it just can't break above that resistance area. Okay? So that's why you want confirmation. That's why you want to wait until a stock breaks through resistance before we buy it. And by the way, when it does it, if we can't see the right side of this chart here, if we were just looking from that week, it's at an all-time high. In fact, it was north of $218 when it offered this entry point. And to most people, that's insane. That's crazy. What's the PE ratio on this stock? I'm not going to buy it, right? But it's $218 for a reason. And it's breaking through resistance after going through a consolidation for a reason. It's an institutional quality stock that the big guys are supporting. And they control the market. So we want to jump on board with what they're doing. Right? Okay? So that's how we time our entries. We simply identify the support resistance areas, identify the most significant resistance, you add 10 cents to that, and that's your buy point. That's your pivot point. Buy point, pivot point, entry point, they all mean the same thing. Okay? Sometimes the paper tries to get real sexy with the lingo, but it's all the same. Okay? So that's our entry point, and it goes on to make even higher highs, and it's all fueled by institutional buying. Okay, and this is not an anomaly. This is not, well, that's one stock in the last 10 years. No, this happens every major bull cycle. Okay, leading growth stocks are going to give you multiple opportunities to buy them. I mean, think about Apple over the last 3.5 years. It wasn't one move from $90 to $700. It was a move up followed by a consolidation. It breaks out, and then another move up, and then another consolidation. And what we do a really good job of at IBD is identifying these leading stocks as they're consolidating. Because that's really when you want to keep your eye on them. All right, you want to keep your eye on them when they're going through a consolidation, because potentially they might break out. And that's when we want to buy stocks, when they break out, when they emerge from a consolidation like that. Okay? Okay. So I've been talking about CANSLIM, and some of you might be thinking, was that some kind of diet milkshake? What is CANSLIM, right? CANSLIM is 7 traits of winning stocks. It's the way IBD screens the market, okay? It's how we filter how many stocks on there that you could potentially buy between the NASDAQ and the NYSE. There must be over 10,000. I mean, I don't even know, okay? So how do you know which ones to buy? Well, IBD uses CANSLIM almost as a filter to filter those 10,000 plus stocks. And what you see that ends up in the paper has made it through a very rigorous screening criteria. In fact, I said earlier that there's a lot of stocks in this paper. There really isn't. It seems like there is, but there really isn't. If you took the amount of stocks in this paper, compared it to the market, it's probably less than 0.5% of the entire market that actually makes it to our paper. There's a lot of redundancy in this newspaper. There are stocks showing up on multiple lists, multiple screens. So really, there's not that many stocks. So what IBD does is filter the market to give you the top maybe less than 0.5%. Now from there, I'll show you later how we go and actually find which ones of those less than 1% that we want to put in our watch list. But CANSLIM essentially is our screening methodology. Okay, you can see what it stands for. I'm not going to go through each letter in this acronym, but essentially we use a combination of technical analysis, which is the chart, and fundamentals, which is stuff like a company's earnings and sales and profit margins, return on equity, all that stuff. We take all of that into account. So we're a combination of fundamental analysis and technical analysis. The reason why we use charts is to simply time our entries into the market. That's why we use charts. They're a timing mechanism. They help us time our entries, and eventually they'll help us time our exits from our positions. That's why we use charts. Fundamentals help us screen for stocks, okay? So I'm going to skip the first 6 letters of the acronym because the most important letter in this acronym is going to be the M, okay? Market direction. And why is market direction so important? Is my mic even up?
Yeah.
Okay. Why is market direction so important? Historically, we know 3 out of 4 stocks will move with the direction of the overall market. That's why it's important, okay? So when the market's uptrending, most stocks will move that way. And when the market's in a downtrend, that's how most stocks will move, okay? We know the market has cycles. And at IBD, we identify the cycle of the market in one of 3 ways. Confirmed uptrend, uptrend under pressure, and correction. Okay? We don't really use the term bull market or bear market to define the current status of the market. They're too vague. They're too general. You could argue we've been in a bull market since 2009. But during that time, there have been times where it would have been wise to maybe move to cash. Okay? If you step back even further and go from 2000 to 2013, you can argue we've been in a bear market the entire time. Okay? So that's not relevant to you. Anytime you're watching CNBC and you hear some economist get on there and say that he thinks we're in some kind of bear market, bull market, irrelevant to you as an individual investor. Completely irrelevant. In fact, I would argue 99.9% of what you hear on those channels is completely irrelevant to you. Doesn't matter to you, okay? So you're much better off viewing the market in these terms. Confirmed uptrend, under pressure, and correction. And by the way, when I say the market, I'm going to use the word the market a lot. I'm talking about 3 indexes. The S&P 500, the NASDAQ, and the NYSE composite. For us, those 3 indexes are the most accurate barometers to determine the overall health of the stock market. Okay? And there's a lot of other things. There's a lot of secondary indicators that you can use. Some people like to use the Russell 2000. There's all kinds of, the financial advisor's sentiment indicator. There's the put volume ratio on options. But the most accurate is going to be the price and volume information on those 3 indexes, okay? So now, let me describe what these 3 terms mean. When you see confirmed uptrend in our paper, essentially that's the green light. What we're telling you is that we're in a confirmed uptrend. Now is a much safer environment to start buying stocks, okay? That's what that means, it's a green light. However, what you don't want to do when we go into a new confirmed uptrend is plunge, okay? You don't want to take all your chips and put them on the table. That's what plungers do, right? What they say about plungers, they die, okay? So we don't want to plunge. When we have a new confirmed uptrend, you want to tiptoe your way in. You want to wade in very carefully. Okay? So if you're buying individual stocks, maybe you take half positions. Maybe you take half of your portfolio and put some test positions out there. Okay? Because what we don't know about this uptrend is how long it's going to last, or even how viable it is. It may last for 3 days and completely collapse. Or it may last for the next 6 months. We have no idea. Because what we don't do at IBD is forecast. We try to make predictions. It's a waste of time. Instead, we simply interpret what is currently happening. And you guys can only make decisions based on what you know, not based on what you think is going to happen. Okay, in fact, the words "I think" should disappear from your vocabulary when it comes to the market. Okay? What you think doesn't matter. What I think doesn't matter. What Bill O'Neill thinks doesn't matter. You do what the market's telling you, right? Okay? So when we have a new confirmed uptrend, you wade in very carefully because you don't know how long it's going to last. If it does turn out to be a solid uptrend, perfect. We can always add to our position. But if it turns out to be a dud, okay, we have less risk in the market. Okay? We have half positions instead of full positions, so we can easily get out. And that's our biggest advantage as individual investors. You know, is that we're nimble. We can get in and out of the market. The big guys can't. They have to stay in the market, and if they do start to get out, it takes them several weeks, if not months, to get out. Whereas you and I, we can get in and out pretty quickly, usually with the click of a mouse. Okay? So, we don't know how long an uptrend's going to last. What we do know is that at some point during the uptrend, the market will come under some selling pressure, right? The guys that control the market, the big institutions, for whatever reason, will start to liquidate positions that they have. And all this liquidation, or heavy selling, is going to put pressure on the uptrend, okay? Now, how do we define heavy selling or liquidation? We do it through what are called distribution days, okay? Distribution means heavy selling, also known as institutional selling. So anytime we're in a new uptrend, we start counting distribution days. Technically speaking, a distribution day is when any one of those major indexes that I talked about earlier close down in price 0.2% or more on heavier volume than the previous day. That's the technical definition of a distribution day. So it's a 0.2% decline in price on heavier volume than the previous day. So it can be very subtle. It's not always these obvious sell-off days. So as the market's moving up, we start keeping track of these distribution days. So one distribution day is not cause for concern. 2 distribution days is not. 3 is not really cause for concern. What concerns us is when we start to get a concentration of distribution days. When we start to get 5, 6, 7 distribution days within a 4 to 5 week window. Then that concerns us. And when that happens, we will change the outlook from confirmed uptrend to now the uptrend is under pressure. Right? Okay? So again, it's the concentration of distribution days. Think of distribution days like if you were on a boat, on a lake, and that boat started taking on water, okay? And pretty soon your boat's filling up with water, and the more water your boat takes on, the more likely it's going to sink your boat. Think of distribution days as boat coming into your water. There's water coming into our uptrend, and the more water that gets concentrated, it's likely to sink the uptrend, okay? So when we go under pressure, essentially that's the yellow light. What we're telling you is be very, very cautious right now, okay? If you're going to take on new positions, be extremely cautious, only buy the very best stocks, because there's been a lot of selling pressure on the market, and if the selling pressure continues, if we get another day or 2 of distribution, then we will be in correction. And correction is the red light. Correction is all bets are off. Okay? Now, when we go into a correction, it's not an automatic sell signal. We're not saying as soon as you go into a correction, go to cash. It's not the way it works. Ultimately, whether or not you decide to go to cash is going to be determined by your individual stocks. Remember, 3 out of 4 stocks will move with the market, right? So what we know is the longer and deeper the correction lasts, the more likely your stocks will also get sucked down with the market. However, if it's a short-term correction, if it only lasts a few days, a lot of leading stocks will hold up through a short-term correction, and you don't want to get rid of them just because the overall market went into a correction, okay? But if your stocks start to act like the market, by all means, if they start to break key support areas, if they're selling off on heavy volume, if they're gapping down in price, if they're no longer finding support at that 10-week moving average line, those are all signs that your stock is breaking down, okay? But until that happens, hang on to them, because you don't know how severe the correction is going to be. Now, what we don't know about the correction, as well as in addition to its severity, is the length. We don't know if the correction is going to last for 6 months and this is the start of a brand new bear market, or if this correction is just going to be a short pullback and the market's going to recover. We have no idea. You got to be prepared for either scenario. What we do know is that at some point during the correction, the market will hit a bottom. Whether that's 4 days into a correction, whether that's 4 months, we have no idea. But we do know it's going to hit a bottom, okay? And what's going to happen is when we hit that bottom, the market will attempt to rally. You'll see it start to rally. And on day 4, or after of this rally attempt, we want to see what's called a follow-through day. Follow-through day. A follow-through day is a big up day in any one of those major indexes after it's been attempting to rally for at least 3 days. Okay? Technically speaking, a follow-through day occurs when on the NASDAQ is up 1.2% or more on heavier volume than the previous day. 1.2% on the NASDAQ or 1.4% on the S&P or the NYC composite. Okay? When we get that big up day after the market's been trying to rally, that gives us confirmation. That tells us, you know what, this rally attempt just might have legs. And we start slowly getting back in the market, and we've completed the cycle. Okay? Okay. So this is kind of how it plays out. This is a screenshot taken directly from the paper. And in the paper, we have these market charts. We got the NASDAQ, and then below that, we got the S&P and the NYSE. So this, what you're looking at here, this is August of 2012, and then this is not today's close, it's yesterday's close, okay? So this is how the market timing kind of plays out over a longer term period, just to kind of give you guys a visual. Back in here, off the chart to the left, somewhere in this area, okay, we had a follow-through day, which a follow-through day is a signal that we are now in a confirmed uptrend, okay? That was July 26th. You guys remember that? July 26th follow-through day? Well, that led to about a 10-week rally, and the NASDAQ was up, I think, at as much as 10%. Okay, so it was only 10 weeks. It was a 10% move in the market. There was plenty of opportunities. Okay, you could have made money during that rally. And then what happens? Well, we start to get distribution, right? We start to get distribution. You see these Ds right here? They're pointing to distribution days. We start getting a clustering of distribution, and on October 9th, we come under pressure, okay? The very next day, we have another distribution day, and the market is now in a correction. And what happens? Well, the market goes through a correction, eventually it finds a bottom, and you're never, using this approach, you're never going to get in at the exact bottom. You don't want to. You want to wait for confirmation. So we hit a bottom on November 16th, and on the 5th day, it's not marked on the chart, but trust me, on the 5th day, we had a follow-through day. It was the day after Thanksgiving. right? Everyone was probably not paying attention, but day after Thanksgiving, market's up. It was a half day. It was a half day on the market, so volume was actually on the chart, looks lighter, but it was projected to be higher than the day before had we had a full day, okay? So on November 23rd, we had a follow-through day. We are now back in a confirmed uptrend, okay? And we kind of don't do much. We just kind of move sideways. You guys remember November, December of last year, what was happening with the economy? There was all this talk about the fiscal cliff, okay? And what happened was there started to be a clustering of distribution days. Why it's happening doesn't matter. There's probably thousands of reasons why, one of them being the fiscal cliff. That doesn't matter to you and me. The fact that it is happening is all that matters, and all we're doing is looking at price and volume, price and volume. Remember, this chart is human emotion, human nature on display. Right? The market's all about emotion and human nature. And it shows up in the form of price and volume. Greed on the upside and fear on the downside. That's all. So that's your best bet, is just focus on the chart. Let the chart tell you what's going on. And what happened during this period is we started getting a clustering of distribution days. I wish they would have left the D's on there. I don't know why they took them off. We had enough distribution where we came under pressure. Okay? Now, just because we go under pressure doesn't automatically mean we will go into a correction. Sometimes the market is able to show resilience, fend off the distribution, and show strength again. And when that happens, we will go from under pressure, and this is December 31st, back to confirmed uptrend, because what we're not going to do at IBD is argue with the market. Okay? If the market's telling us one thing, we're going to do it. We're not going to argue with it. The market's always right, not us. So December 31st, we had a big update in the market. We are back to a confirmed uptrend, and that's led to this move right here. And then we started getting distribution. In fact, let me show you that this is the wrong chart. Let me show you another chart here. Excuse me for just a second. Okay, this is the current one. This is today, okay? So the area I was showing you guys was back in here where we came under pressure. We had a big up day. We put the market back in a confirmed uptrend, and we started to rally, okay? Now you notice on the previous chart, in this area right here, there was distribution. And they're no longer showing up as the market starts to come up. Distribution days are not set in stone. They can fall off the count, okay? And there's two ways a distribution day can fall off the count. We say it's either time or distance. By time, here's what I'm talking about. Let's take the current market. A couple of days ago, we had a distribution day. Well, if 25 trading days go by from this distribution day, that's going to cause that distribution day to fall off the count. It's no longer relevant to the current market. Okay? That's time, 25 trading days, 5 weeks for a distribution day to fall off. The other way a distribution day can fall off the count, if we take the close of this distribution day, whatever the price close was for that distribution day, if the NASDAQ is able to rally 6% or more from the close of that distribution day, that will also cause the distribution day to fall off the count. Okay, so it's either price or simply time. That's it. Okay? So they're not set in stone. So you'll see when the market's in an uptrend, you'll start to see distribution days show up in our paper. And then you'll start to see them disappear when the market gets stronger. You're probably wondering, why are they coming off? Well, because they're no longer relevant. They either expired because 5 weeks have gone by, or the market's been able to rally 6% or more from that day. Okay, does that make sense? You guys following? Okay. So this
applies to any index, not just
that what applies to the NASDAQ. Yeah, any of those three: the NASDAQ, the S&P, or the NYSE. Now, this is what we're looking at currently. Over here is the kind of the current market. Now, what happened is we went back to an uptrend on December 31st, and we had a pretty decent move in the market. Things started to kind of stabilize, and you notice how choppy it was right here? And once we started moving up, it got a lot tighter. Okay, there was a little more certainty in the market, and the market was moving up in a kind of really tight, consolidated fashion. That's what happened right here, okay? Now, we got to a point, however, where we started getting distribution in this area. And we got enough distribution where we had to put the uptrend under pressure. We just had to. There was 5 days on the NASDAQ. They're not up there, but trust me, they were here. There was like 5 distribution days on the NASDAQ. There were 6 or 7 on the NYSE. So there was a large amount of distribution. And then we had that nasty down day, and we could not ignore it. We had to put the uptrend under pressure. Okay? And then 2 days later, we had another nasty down day, a downside reversal. The market closed the bottom of its range for the day, and volume was pretty heavy. Volume was above average. So we can't ignore that. If you can't see the right side of this chart, okay, if you just looked at that day, all signs were pointing to, okay, we're due for a correction. This could be the start of some kind of correction, right? However, the market was able to show resilience, and it started to rally, okay? So technically, this correction means the market is now in a correction, and we start looking for the bottom, okay? Remember what I said. You're never going to get in at the exact bottom. So the very next day was the bottom. However, we didn't call a follow-through day until day 6 of that rally attempt. That's technically when we had the follow-through day, okay? And that takes us to where we are now. And as of right now, I think today was another distribution day. We should have 3 for the NASDAQ. You'll see in tomorrow's paper another D, and that's going to give us 3 for the NASDAQ. I'm not sure what the count is on the other indexes. Okay. Yes?
On that second to the last distribution day there, I see the volume didn't touch above the first
Yeah.
day or no.
Yeah. Right here, right?
Yeah, I thought it had to go
Yeah.
above before.
No. No. So distribution day, remember, it's only heavier volume than the previous day. It's not above average volume. So in this case, first of all, the question was, on this distribution day, volume was below average. But the technical definition is it only has to be heavier than the previous day. Okay? That's the technical definition of distribution. All right. Okay, so now let's take out our newspapers. Yeah. Back on the chart? Yeah.
The confirmed uptrend in the middle of the chart there, that came on 1 day's trading.
Yeah.
There was no momentum built.
Right, because we never technically went into a correction. Okay, we were under pressure, and because we never technically went into a correction, we can go back to confirmed uptrend as long as the market shows trend. In this case, it kind of looks the same, but technically we went into a correction on this day. That's the difference. Okay. We're not always right. Okay, as you guys can see, we probably made the wrong call going into a correction on this day. We probably should have stayed under pressure and eventually went back to confirmed uptrend. What we're not going to do at IBD is have a position and stick with it, and stick to our guns, and just dig in and say, no, we think the market's in a correction. If I've done it, it's going to stay that way. If we're wrong, we're going to correct ourselves. Okay, we will correct ourselves, and we have no problem correcting ourselves. We're not going to argue with the market. Okay.
I have one other question.
Yes.
What causes the, on the volume bars, the red or blue? The previous day's volume or what?
Okay, so the question was, what causes the red
Oh,
or the
now
blue
it is.
volume bars?
Yeah.
Remember, the volume bars line up with the price bars. So forget about color. Just think when the market's down for the day, the volume bar is going to be pink or whatever it is. Okay, that's all it is.
I just missed that point when you said.
I don't think I said, but thank you for reminding me. Okay. Okay. So let's take that out of newspapers. And we're actually going to start with the B section. We're going to come back to the first section a little bit later when we talk about the big cap 20. But we're going to start with the B section. And I kind of need a volunteer. As we go through the paper, what we're going to do, we're going to build a watch list. And I need someone to write down the tickets so that at the end of the class we can put our watch list together. Anyone want to volunteer? Anyone? Anyone? Ed? Ed? Okay. Okay. So let's take out the making money section. And we're actually going to start in today's paper on page B2. Now, this page is called What's the Market Trend? This is where I got the screenshot for this chart. Okay? In today's paper, it's on page B2. It's either going to be on page B2 or page B8, depending if it's Monday or Wednesday. It's going to be pushed back because we have a list called the IB50. But it's either on B2 or B8. Okay? In this case, it's on page B2. So this is going to be your first stop every day. In fact, I would argue this is probably the most important page in the entire paper because no matter how you trade, whether you're trading CANSLIM or whether you're trading some other kind of methodology, being in tune with the market applies to everybody, right? Okay? So this page is telling you the current direction of the market, the current outlook. Now, where do we find that? Well, in the paper, there's a section called the big picture, and within the big picture, there's a box that says market pulse. In that market pulse is where you will find the current outlook. Okay? So what does it say in today's paper? Confirmed uptrend. So right now, you have the green light to buy stocks. We are in a confirmed uptrend. Yep, it's a much safer environment right now. The next thing you want to look at is right below that. You guys see where it says distribution days? Okay, how many are there for the NASDAQ? There's 2 for the NASDAQ, and there's 2 distribution days for the S&P. After today was another distribution day on the market. So tomorrow's paper, you should see 3 for the NASDAQ, 3 for the S&P, and I think the NYSE was down big too, so 1 for the NYSE. Okay, it's still not cause for concern. It's still no reason to start getting alarmed, but when you see that start to get 5 or 6, okay, that should get your attention, okay? But as of right now, we're still good. There's no reason to panic right now. So we're in a confirmed uptrend. There's 2 distribution days for the NASDAQ. There's 2 for the S&P. So anytime anyone asks me, Ed, what do you think about the market? Tell me about what do you think the market's going? What do you think the market's going to do? This is what I tell them. Well, right now the market's in an uptrend, and there are 2 distribution days for the NASDAQ and 2 for the NYSE and 2 for the S&P. That's my opinion about the market. That should be your opinion too. Okay? What do you think about the market? That's better than having an opinion. It's safer. Okay? So when I ask Ed Berry, tell me your take on the market. You know what Ed's saying? Well, right now we're in a confirmed uptrend, and we got 2 distribution days on the NASDAQ and 2 for the S&P. That's it. Okay? None of this, well, based on what happened in Cyprus, and based on what potentially could happen in Greece and France and Italy and Spain, I think that the market's going to start to capitulate and, just barfing up stuff. That doesn't matter, because no one cares, because no one should care about your opinion. And you shouldn't be asking for other people's opinion. Unless it's Ed for financial advice, of course. Right? But Ed uses facts. Ed uses the IBD. He's not caught up in opinions, right? Okay? Okay. So that's market direction. Now, if you want context to this market pulse, then you will read the big picture article around the market pulse. And that's going to provide you with context, okay? So right now, as individual investors, what we know about the market is right here. That's all we have to know, okay? Whatever happens in overseas, if it's going to affect the market, it's going to show up in the form of price and volume on the major indexes. Okay, so now we're cool with market timing, cool with market direction. The next step is to actually find stocks, okay? Let's go through this paper to try to find ideas, because we need to always constantly be building our watch list. Okay, we can't take a break from that That's a constant thing. So I'm going to show you where I go to find watch list stocks. So our next step, before I get into that, I'm sorry. Let's stick with market timing here. Okay. What you're looking at is the NASDAQ, and this is from 2006 to now. Well, June of 2013. Okay. This is the NASDAQ. It's a weekly chart. As you can see, it's been pretty bumpy, right? There's been a lot of volatility on the market, right? So this is the credit crisis. This is the crash of 2008, and then the bottom of March of 2009, and then this is, I believe this is August, September of 2010, and then there's that rally there, and then this is that tough, choppy 2011. So there's been a lot of up and down, up and down, up and down, okay? Now, using this market pulse, the market pulse in this paper, during this period, if you would have bought the NASDAQ, aka the QQQ, or any other ETF that follows the performance of the NASDAQ, when we first go to confirmed uptrend, and then sell it the first time we come under pressure, over the last 7 years, your return would have been 107% versus 49% for the NASDAQ composite. Okay? And the reason why the return is far greater is because you're not sitting through these steep corrections. Okay? You're getting out of the market when we go under pressure. Now, does that mean you might be back and forth, in and out? Yeah, probably in a year like 2011, you'd be lucky if you came out ahead. You may have came out just a little bit under, a little bit in the red. But compared to most, people, that's not bad in a year like that. Okay, but overall, if you stick with that strategy, just by trading the SPY or the QQQ, and you buy when we first go into a confirmed uptrend, that's the critical part. You have to buy the very next day that we go into a confirmed uptrend. So the first time you see it in the paper is when you buy the SPY or QQQ. And then the first sign of trouble, when we first go to under pressure, is when you get out. You don't wait for correction. You want to have as little drawdown as possible. Okay, so you sell when we go under pressure. And that's that return you would have got. And all that is, that's not sophisticated. That's not having 5 computer screens with a bunch of blinking lights in front of you. It's just using a paper and using that market pulse and letting it guide you, telling you when to get in and when to get out. Okay? Yes?
Question, say we're going to a downtrend, right?
Yeah.
And you're in several stocks. Now, as you progress in the downtrend, it's going to go against you. You haven't talked about stop loss or something to get you out. You're talking about getting in. How about getting out?
Okay,
on an individual stock?
Yeah, let's talk about that. So the question is, how do I know when to sell? Okay? And a lot of it's going to depend. There's a couple of schools of thought of understanding when to sell. What I'm going to give you is one school of thought. There's 2 ways to sell. There's selling into strength, also known as offensive selling, and selling into weakness, also known as defensive selling. Okay? So when you own a stock, the goal should be to sell into strength. Sell as the stock is still going up. Psychologically, that's hard for a lot of people to do. Okay? Selling your stock and then it goes up another 10% after you sold it. That can be difficult. And I can see that. Okay? So if you're up in a stock, God willing, let's say you're up 18-20%, and you want to figure out, well, when do I get out? Well, there are 4 questions you can ask yourself, okay, that will help you. And use these as a foundation. The first question you want to ask yourself is, has my stock broken support at the 10-week moving average line? Remember, that 10-week line is the key support area. If a stock pulls back to that line, you want it to find support at that line. However, if it breaks through that line on the downside, that's usually not a good sign. Okay? and if it's unable to recapture its 10-week line, but instead trades below it, and now that 10-week line is acting as resistance, that could be a bad thing. So that's the first question. Has my stock broken support at the 10-week moving average line? Second question, is my stock gapping down in price? You guys know what gap downs are? Okay, if you look on a stock chart, you guys know what a gap up is. Stock reports earnings, you sold it the day before, and it gaps up 20%, okay? Well, gap down is just the opposite. It's when it closes, it's when it opens lower than it closed the previous day. Okay, that's a gap, it causes a gap. Is my stock gapping down? They're not always dramatic, like after an earnings report. Sometimes they're very subtle, there's a subtle gap. That's the second question you want to ask. See, what happens with the gap down is that it creates these little pockets of resistance, which make it very difficult for the stock to overcome. Okay? So that's the second question. Is my stock gapping down in price? Third question you want to ask. Is my stock being sold off on heavy volume? So as my stock is coming down, what does volume look like? If it's coming down on some serious volume, remember how we identify heavy volume? If it's above the average line, that's a sign of institutional selling. That's telling you the guys that control the market are selling your stock. And if they're trying to get rid of it, why do you want it? Okay? So that's the third question. The fourth question has to do with market direction. Has the market direction changed in a bearish way? Have we gone from confirmed uptrend to now the uptrend's under pressure? Or have we gone from under pressure to correction? Okay, those are 4 questions. My rule of thumb is this. If I could answer yes to at least 3 of those 4 questions, more often than not, that's going to give me the conviction to get out of my stock. If I can only answer yes to 1 or 2, sometimes I'll say, you know what? It's only done 2 of those 4. I'm going to give it some room to breathe. Because stocks, they need room to breathe, right? They need room to go through a correction. And you don't want to sell too early. It's a shame, right, when you sell a stock because you think it's going to go down and it's just going through a temporary pullback and it comes out of it. It happened to me a few times. And it will happen again, okay? But this will guide you. This will be a better guide for you. So if you answer yes to 3 or 4, you know what to do. You know to get out. If you only answer yes to 1 or 2, be patient. Give it some room to breathe. Because maybe it's just going through a temporary pullback and it's going to emerge from that pullback. So what those 4 questions do is they completely remove emotion from the equation. Right? You're no longer caught up in emotion. You're being as robotic as possible. It's a checklist, right? And you look at a chart and you read your checklist and you check yes to 3 of them, you get out. You check yes to 1 or 2, you hold on to it. Keep in mind, those are very defensive in nature. So you're going to give back a little bit of profit, but what you won't do is ever round trip a stock. Anyone ever round trip a stock? Raise your hand, I have. You're up 18% and then you lose it all, you give it all back because you have no sell rules. All right, so those are 4 to start off with. In the book, How to Make Money in Stocks, there's 22. Half of them, see more than half, are offensive. Okay? Learn the offensive sell rules. And ultimately, you want to be an offensive seller. But those defensive rules will definitely help you protect most of your capital.
What about the 8% rule?
The 8% rule only applies to your initial purchase price. Okay? So the question was, what about the 8% rule? We have a rule that says if when you buy a stock at the purchase price and it moves down 8% below that purchase price, you sell it, you get out, no questions asked. That only applies to your initial purchase though. Once you're up, 15%, 20%, you're not using that 8% rule anymore. You're not going to wait until it drops 8% below your purchase price if you're up 20% to sell it.
Well, what about the existing price? You're up 20% and it drops 8%. Won't you get out?
That doesn't apply. The
Why not?
8% rule only applies to your initial purchase price. What I'm saying is, if you're up 20%, if your stock moves down 8%, most likely it gapped down. Most likely it lost support at its 10-week line. Most likely it's being sold off on heavy volume. Use that as a guide. Because what if you're up 100%? You can deal with an 8% drop, right?
Well, 8 could turn into 16%.
Sure, but the more cushion you have, the more flexible you can be with the pullbacks. But if you're only up 20%, well, 8% is a lot of 20%. You're giving back 8%, now you're only up 12%. But if you're up 100% and the stock moves down 8%, you're not going to get out. What if it emerges from that small pullback? Use price and volume action instead of set 8% rule. Because that 8% rule, a lot of people misinterpret that. That only applies to your initial purchase price. That's to help you preventing a stock that went up, that broke out, and is now coming down after breaking out. It helps you prevent that 8% loss from turning into a 16 or a 20 or a 30% loss. Cut your losses short, right? Yes, I had a question back here?
Well, just reflecting on that, because I was wrong again. I thought it would have been 8% down from the high and sell it.
No, no. In fact, in a volatile market, we would agree that the recent market has been, over the last few years, has been pretty volatile. I'd cut that to 5 to 6%. You know, why let it get to 8%? Stocks should act a certain way when it breaks out. And what it shouldn't do is pull back below its entry point. Okay? Is that clear? Did I clear that up? You guys write down those 4 sell questions? I didn't see anyone writing down. I guarantee I'm going to get a lot of questions afterwards. Can you tell me the 4 questions again? If you want the 4 questions, talk to this guy. Okay. Okay, so now let's actually go to the paper and find stocks, okay? So one of my favorite lists to look at is going to be the stock spotlight, and today that's on page B5. Okay, so again, remember, we screen the market for stocks that are fundamentally and technically sound, okay? As far as the fundamentals, for the most part, that's been done for you, right? We don't expect you guys to go through financial statements and balance sheets and try to figure out, well, does this stock have the right earnings? Does it have the right sales, profit margin? No, we do that for you. We have an entire research department that looks at all these stocks and screens them out, and that's how they show up in the paper, okay? So our job really is to use the chart and identify stocks that are consolidating. Remember I talked about that consolidation, right? The support resistance area. So this is one of my favorite lists to use. It comes out every day in the paper, okay? And you're always going to get 16 stocks every day. But the list doesn't necessarily change every day. You're not going to see wholesale changes. Tomorrow, when you pull up this paper, you're not going to see a brand new list of 16. In fact, you'll see a lot of the same stocks reappear on this list day in and day out, probably for several months, until they show weakness and they start to rotate out, and then you'll see other names make up the list, okay? What I've noticed about Stock Spotlight is that usually stocks will show up on this list before they show up anywhere else in our paper. And because of the screening criteria, which is proprietary by the way, because of the screening criteria, it tends to catch newer names, okay? Now, how do you use this list? What you don't want to do is put all 16 on a watch list, okay? You want to identify the ones that are doing one of 2 things. Either consolidating, remember, or just kind of moving sideways. Maybe it's forming some kind of cup consolidation. And or pulling back and finding support at the 10-week moving average line. Because remember I said, you can buy a stock when it bounces off the 10-week moving average line. That's a legitimate entry point. So let's go through this list right now, and let's identify stocks that are doing one or 2 of those things. So the first stock, United Therapeutics, I'm sorry, the first stock is multimedia games, okay? That stock is extended. Right away, I know that stock is way beyond its 5 point. Okay, it's 5% or more beyond its 5 point. That's considered an extended stock. I cross it out and I move on to the next one.
Well, how do you know that, Bob? How do you know? By looking
Because
at-
remember, we want to buy stocks after they've emerged from a consolidation. So if we look at that first stock, multimedia games, the consolidation was, you see that period where it just kind of, I'm pulling the paper like you guys can see it, but you see that period where it just was moving sideways? It was a few months ago. And then it had that big week where it came up. Okay, that was the breakout. That's when it broke out of that consolidation. That would have been the proper time to buy. When a stock breaks out and goes through a resistance area, you have a 5% window from that resistance area and up to safely buy it. So it's like you have this window. So let's say the resistance is $30. Well, you add 5% to that. My math sucks. I don't know what 5% of plus 30% or $30 is. But what is it? So $36, okay? Okay, whatever. Let's say it's $32. So your buy area is from 30 to 32. Once it gets outside of that 5% buying range, then we consider it to be extended. And you don't want to chase stocks that are extended, because what's going to happen is you might get caught in the pullback, because we know all stocks pull back. And if you get caught in the pullback, you're now trading from a position of weakness. You buy it, it pulls back, and you're already in the red. Okay? When you buy a stock, you want to be in the green, at least for a few days.
And you always base this on a weekly trend.
We use a combination of weekly and daily. The question was, we always base this on the weekly chart. The reason why we use weekly charts to identify consolidations is because the weekly chart smooths out the daily fluctuations of the daily chart, right? The whipsaw. So with the weekly, it's a lot easier to identify these consolidation areas, okay? So let's look at the next one, United Therapeutics. As you can see, it formed this really odd-shaped cup base, okay? And it broke out, and it's actually still within its buy range. It broke out a few weeks ago, and it's just kind of hanging out within its buy range, okay? So you circle that ticker symbol, and Ed, this is the first stock we're going to put on our watch list, UTHR. What about the next one, SkyWest? SkyWest formed about 6 weeks ago, broke out of that little cup, okay? And it broke out, and it's 5% beyond its proper entry point, so that one is getting crossed out. What about the next one, American Railcar? You think that one's extended? Yeah. Okay, what about medicine companies? It's kind of hard to see, but the very last week is a down week, and it looks like it's pulling back. By the way, that line, that black line going through the price bars is the 10-week moving average. It looks like medicine companies is pulling back and finding support at that line. Good, let's circle that one. MDCO, MDCO. What about Parexel? That's extended, okay? See how it's not near its 10-week line, and its last consolidation was about 3 weeks ago. So now it's extended. You move on to the next one. Popular Bank, or BPOP. What do you guys think about that one? You guys, it looks like it's consolidating, and it's finding support at 10-week line. Watch list, BPOP, BPOP. Okay, what about Cardinal Financial? Cardinal Financial was consolidating, and then that big up week, it broke out of its consolidation. So now it's extended. Cross that one out. Move on to the next one. Air Lease, extended. Cross it out. Move on to the next one. Fly Lease, or Fly Leasing, extended. Move on to the next one. Evercore, extended. Move on to the next one. Lionsgate, extended. Move on to the next one. On assignment. Well, you can kind of see the last 2 weeks it's been pulling back to its 10-week line. Beautiful. Watch list. ASGN. Sturm Ruger. Same thing. You see how it's kind of finding support at that 10-week line. Watch list, RGR. Okay, US Silica. It's pulling back. It looks like it's finding support at the 10-week line. SLCA, US Silica. Now, just a little nuance here, okay? When the stock pulls back to its 10-week line, you want to look at how it pulled back. In other words, what was volume like when it pulled back? We want volume to dry up anytime a stock pulls back to a key support area, whether it's the 10-week line, whether it's some kind of prior resistance area. You want volume to kind of dry up, okay? US Silica pulled back. You see that 1 week it pulled back? And look at the volume that week. Look how high that volume is. What is that telling you? That's a sign of institutional selling. That tells you that the Hartford, if they owned this stock, they were probably dumping some shares, okay? Is Hartford that way? Or is it that way? I'm from California, what do I know, huh? Or in my case, CalPERS, right? CalPERS is dumping shares that day. Okay, so, but in the meantime, we can still put it on our watch list because just because it pulled back on heavy volume doesn't mean it's not going to rebound and bounce off that line. But if it does eventually bounce off that 10-week line, you want volume to be just as strong on the upside, if not stronger, okay? What about the last one, Ocwen Financial? That one's been consolidating for several months, right? Okay, watch list. OCN, Ocwen Financial, beautiful. So of these 16 stocks, how many did we find to put on our watch list? 1, 2, 3, 4, 5, 6, 7. Okay, good. We don't want to put everything on our watch list. We don't want to clutter our watch list with extended stocks. You know why? Because these extended ones like Air Lease, when they start to pull back, they're going to still be on this list most likely, and you'll see them when they're pulling back, and at that point, you can put it on your watch list. For now, don't clutter your watch list with extended stocks. Keep them on. We'll watch them for you. As long as you're going through this list consistently, you will be able to identify them when they are consolidating, because that's really when you want to pay attention to them. Okay, does that make sense, guys? All right, so that was Stock Spotlight. Okay, let's go to the next list, which is actually on page B3. Sector leaders. Remember, these are all just screens. Okay, these are screens that we run. Sector leaders is one of our most tightest screens, and it's one of the most difficult screens to make. That's why there's only 6 stocks on the list today. Just like that stock spotlight, you aren't going to see wholesale changes day to day. Usually you'll see the same stocks for several weeks, if not months at a time, okay? Now, one of the pillars of the CANSLIM investing approach is that we want to, so we've identified 33 sectors of the economy, okay? And like retail, medical, software, computer, manufacturing, those are all sectors. And we've identified, we put them into 33 categories. One of the pillars of our approach is that typically you want to stick with the best stocks from those sectors. Okay? You don't want to buy the junk, you want to buy the true leaders in their sectors. So not every sector, not every one of the 33 sectors has a sector leader. Okay? In this case, there's only 5. It's a very tough screen to make. So now, what you want to focus on, don't worry so much about all this information up there. A lot of people get really caught up in all this right here, okay? This has already been screened. Most likely, this is all the fundamentals, all this stuff up here. That's, earnings and sales and return on equity. Most likely, that's already been screened out for you. You can make the assumption that fundamentally, these are strong stocks. So now the next step is to identify what's going on with these stocks technically. And what I like about this list is we actually give you guidance. Unlike the stock spotlight, we tell you what's actually happening with these stocks. So let's look at our paper today. And let's look at the first stock, Combine. What does the analysis say under the chart? It says breaks out of a flat base. It's up 4% from its buy point. Remember I told you guys you have a 5% window from the buy point. So this is, remember, this is as of yesterday's close. I don't know, I'm sure it was down today. But it's still within that buy range. So this is technically a stock you can buy, okay? So we're going to put CVLT in our watch list. What about the second one, FleetCor? What does it say? Sketches 3 weeks tight pattern with potential $73 entry. Okay? 3 weeks tight. It's a pattern that has been happening a lot lately. Essentially what we mean by 3 weeks tight is, if you look on this chart and look at the closes for the last 3 weeks, they've been within 1.5% of each other. We consider that to be tight trading. Tight trading is very constructive. So when a stock does that 3 weeks in a row, that's called a 3 weeks tight pattern. When it emerges from that pattern, that's when you want to buy it. In this case, $73 is the buy point. How do we get that buy point? We take the high, the intra-week high in that pattern, and we add 10 cents, and that's our buy point. So what does that intra-week high represent? It represents potential resistance. So we want the stock to prove to us it can break through resistance, so we add 10 cents. So so the intra-week high is 72.90, we added 10 cents, that's how we arrive at 73. That's your buy point. Yes, sir?
No, you wouldn't buy it earlier.
No, right? If you want to be aggressive, you can. But you want the stock to prove to you that it has the ability to emerge from that pattern. Yeah. Okay? So, I had a question, yes?
How do you know the 72.90?
Oh, because they're telling me the buy point's 73,
Oh, so you are.
so I'm just deducing that it's 72.90.
And do they have 10 cents whether it's?
Yeah, good question. So the question is, do they add 10 cents whether it's a $30 stock or a $300 stock? Yes. 10 cents just, it's significant in that it has, the stock is showing it has the ability to pass through resistance. Doesn't matter if it's only 10 cents. Okay? It's a good question. Okay. So FleetCor, FLT is going on our watch list. What about the third one, HomeAway? Pauses 9%, it's 27.57 buy point. It's 9% above its buy point from a 5-month cut base. So remember, you have a 5% window. This one is what? Extended, right? So we move on to the next one. Forget that one. Jazz Pharmaceuticals, 1% over its buy point. Okay. Watch list, GAZZ. LinkedIn, extended. As soon as you see the words extended, move on. Aquin Financial. Here's Aquin. We saw this one already on the stock spotlight. Okay? So remember, there's a lot of overlap in our paper. That's a good thing. So of these 6 stocks, we found 3 more that we can add to our watch list. Okay, so far we have 10 stocks in our watch list. Okay? Any questions about the sector? Yes. I'm sorry, he had a question. I'm sorry.
In regards to Jazz Pharmaceuticals, when you're looking at these things on your watch list, do you follow the trends and things that are going on within the company with?
I am aware of when they report earnings.
Right.
Okay,
It was a
because
big thing that happened to them today. That's why I was-
yeah, absolutely. I mean, look, you put it on your watch list for a reason. So I don't know what happened to it. What did its price action do today? You know, it went down. So you get it off your watch list now. Okay? Because ultimately, it's going to be the price and volume that guides you, right? Why it went down, who knows? I don't understand that business industry. But it's probably some bad news about a drug that didn't get approved by the FDA. So it probably gapped down on big volume. So now all you need to know is that it gapped down on big volume. It's off my watch list now. Okay? Aquin Financial, I said that we saw it earlier in the other list. So that's usually a good sign. When stocks can make multiple lists, that's typically a sign of strength.
You know, it broke down below the
Today it did?
yeah, the price.
Oh, I didn't, this, yeah, you know, so put these on your watch list, and then what you're gonna do is you're gonna prune it. So tonight, when you open up your watch list, if it's no longer near its buy point, if it's breaking down, if it's selling off in heavy volume, get it out. Okay? Yes, sir.
On Aquin Financial, going back to October, you have 2 consolidation areas there? or is that-
Yeah, here's one, and here's another one.
All right.
So that's typically called a base on base, okay? It's a very constructive pattern. Okay, let's move on. And I know the IB50, so this is not in today's paper, but this is probably our most misunderstood list, okay? Top 50 growth stocks, your numbers 1 through 50. What you don't want to do is buy the number one stock simply because it's number one. Or short the number 50 stock, or short the number one stock because it's already had its move. Surely it's going to break down, okay? That's not how this list is meant to be used. It doesn't work that way. Here's my advice, my suggestion. I'm always trying to find reasons to eliminate stocks, either from a watch list or just even from research. So what I've noticed about the IB50, and this has been confirmed by some of the market team writers, is that typically the best stocks will be concentrated in the top 25. Okay? So right off the bat, I'm eliminating the bottom half of the list. I only need so many stocks to watch. I can't watch hundreds and hundreds of stocks. So if I know that information, beautiful. Top 25, and that's where I'm going to try to find my watch list stocks. Now, once you get in that top 25, again, forget about the number rankings, but instead, read the analysis under each chart. Isolate the stocks that are near a buy point. Forget about the stocks that are extended. And if you go to the top 25 and you only found one stock, okay, then you can dig deeper and go to the bottom half. But if you find enough in the top 25, maybe you avoid the second half of the list. Okay, you can if you do. That's something you can try. I do that because I don't like to look at too many stocks. Okay. All right. Weekly review. This comes out every Friday. Again, unlike the IB50, there is no limit to how many stocks can show up on this list. It comes out every Friday in the paper, and if it's a good, strong market, you'll see 100 plus stocks on the list. When the market gets really weak, the list will start to contract. Okay? Just like the IB50, though, you have that one-line analysis under each chart. Okay? You're going to see a lot of the same stocks. You're going to go through that list and say, oh, I saw that stock in the IB50, or I saw that on the stock spotlight. Remember, that's a good thing. When you see a stock that is making multiple lists, because think of these lists as streams, and they all have their little separate criteria. So if the stock can get through multiple criteria, that's a good sign. Yes? I'm sorry. Okay. All right, the Big Cap 20. The Big Cap 20 is in today's paper, so let's take out the first section of today's paper. Okay? This comes out every Tuesday, and it's always going to be in the A section, and today's on page A11. 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 No, those are actually the market team generated comments. That's why they're not always accurate. No, but that is why sometimes you may read the comment and disagree with the comment. Okay, that's okay. But they're very helpful. Okay? All right, the Big Cap 20. This is the top 20 big cap stocks. You don't necessarily have to give up price appreciation to buy big cap stocks. When I say big cap stocks, what do you guys typically think of? General Electric, IBM, you know, big companies, right? Well, I mean, Apple in its heyday was a big cap stock. Netflix was a big cap. Priceline is a big cap stock. You know, Chipotle. Those are all Intuitive Surgical big cap stock. So you don't have to give up that growth price movement to get in on big cap stocks. And this is your top 20 every week, okay? Again, read the analysis under each chart. Let's go through today's list. What does the first one say? Celgene. Ends 8-week hold rule, no sell signal, shakes off Monday slide. Okay, that's a little vague. Sometimes, because it's done by a human, you got to kind of read between the lines. Essentially, Celgene is extended, okay? What about number 2, BlackRock? Just off record high after bounce from 10-week line. So this one bounced off its 10-week line, and it's really what it should say is extended from the bounce off 10-week line, okay? LinkedIn, extended, good. Gilead Sciences, extended. Okay, next. HCA, what does that say? Shapes second stage base with potential buy point at 3970. Beautiful. Okay, thanks, Ed. So we're putting HCA on the watch list. So I'm going to go, I only have 5 minutes here. Number 5 is going on the watch list, Ed, HCA. Number 9, Valiant Pharmaceuticals. Number 11, Cameron International Corporation. Number 12, Motorola. And number 18, Cerner. Okay, so HCA, Valiant, CAM, MSI, and CERN. Those are all going on our watch list because based on the analysis, they're telling us these are all stocks that are nearby one. Okay, really quickly, let me wrap it up here. Okay, so we're going to take those tickets. You guys take this. You know what? I don't have time to actually go through it, but did you guys get those ticker symbols? Okay, you didn't talk to Ed. But what you're going to do is you're going to go back and you're going to put those on a watch list. Okay, and I would recommend doing it on investors.com, our website, because there's a key bit of information on investors.com. When you put your watch list on investors.com, tomorrow morning, when you open up your watch list, what I want you to do is sort. There's going to be different sorting criteria once you put it on your watch list, okay? Sort the list by price percent change, okay? So tomorrow when the market opens, you're going to sort the list by price percent change, and you're going to see what's moving from your list, okay? And if you see something is up 2%, 3%, that could mean it's going to a 5-point, okay? Or it could mean it's getting that bounce off its 10-week line, and that's your cue to take action, okay? So it's very important that you take these stocks, you put them on a watch list. What I did over the last 20 minutes or so, you got to do that at least once a week. Go through the paper, because what you're going to find is some of your stocks that you put on your watch list this week are now breaking down maybe. Maybe they were finding support at their 10-week line, and now they're completely collapsing. Get them off your list. So once a week, go through your watch list. If you see something breaking down, take it off. In fact, you can ask yourself those 4 sell questions I gave you earlier to help you determine if you should take a stock off your watch list. Okay? If it's holding up, keep it on your list. But if it's breaking down, get it off. Do that at least once a week. Okay? And then maybe you find other ideas to put on. Or maybe your list is only 5 stocks, and that's fine. I try to keep my list between 10 to 15 ideas. Okay, once I get to 20, it's starting to get a little too heavy for me. Okay? Keep it small, keep it focused. Okay, so this is the routine. These are the sections you want to hit up on a daily basis. I didn't talk about the stock analysis videos. And then on a weekly basis, you want to look at our different lists. Okay, and then you want to do the watch list maintenance. And obviously, you want to do the investor education, which is where Ed comes in, because Ed runs the local IBD meetup group. Okay, both meetings once a month, and they talk about these things that I just went over with you. Okay, it's a discussion group. It's free, right? Yes. Okay, it's free. Show up. Ed holds it in his office, and you guys talk to market. Okay. Come up with watch the stocks, talk about the current market. It's all free education. Now, in addition to the education piece, or in addition to Ed's group, at IBD we offer free product training if you're a subscriber. Okay. So what that means is you get on a call with myself or one of my colleagues. Typically it's one-on-one, and we use GoToMeeting. You guys know that GoToMeeting where you can see my computer? And we train you and teach you how to use the product, how to build your watch list, how to time your entries. If you want to learn offensive sell rules, we can talk about offensive sell rules. The sessions are free for the life of your subscription. And you can take as many sessions as you want. If you want to take 6 over a 6-day period, you can. And you probably won't, but you can. They're free. So that's part of your education package, as long as you're a subscriber. Okay? Now, if you're not a subscriber, or if you want to renew, everyone should have 2 flyers. Okay? You guys have these? Okay. Okay, if you don't have them, they're in the back. but who doesn't have a subscription? Raise your hand. Okay. So what you want to do is you want to start off with the most basic one. It's actually the cheapest one. It's $28.95 for 2 months of the electronic version of our paper. Okay? You can do that routine the night before because the EIVD, the electronic paper, comes out the night before. It's 2 months for $28.95. You get the product training. We're going to send you to one of our workshops for free. Okay, normally they're $100. You go for free. And we're going to send you a book called How to Make Money in Stocks, which is going to be your reference manual that you're going to use to help you determine. Every time you have any questions with the stock, you look up How to Make Money in Stocks, you refer to it. All the rules are laid out in that book. It's by William O'Neill. All that comes with that $28.95 subscription. If you're a current subscriber and you want to renew, on the back of the sheet are discounted subscription rates. Okay? And I highly advise that if you're expiring soon, or even if you got 6 months left on your expiration date, to renew here because you get a discount, you get an extra month for free, you get the O'Neill book, the free workshop ticket, and the product training. Okay? So, and then this one right here is leaderboard. You want to take leaderboard? I didn't talk about it tonight, but you can do that as well. Okay? So, any questions about anything I talked about, folks? Yes?
Where are the workshops?
We have them all over the country. The closest one probably is, Ed, what's the closest workshop we usually have?
So in Boston.
Oh, Boston, okay, Boston's probably the closest one, okay? But it's normally $100, but we'd send you guys for free. We give you a free ticket when you take the trial, or even if you renew your subscription, okay? Just need to take action. Now, the only caveat is you gotta do it tonight before I go home, so I can get that offer to you, okay? Yes, sir.
I was just curious, if your watch list has 10 or 15 ideas on it, any given day you want to buy something, you think you're likely to find something on that list?
Yes, because I know those are the stocks that are in the IVD that are near a buy point.
So,
Now, I'm gonna miss some stocks, don't get me wrong, you'll miss some stocks, but it's a discipline, right? If you do that week in and week out, guess what? You're gonna see Apple when it's consolidating at $150, and when it breaks out, you're gonna buy it, and eventually you're gonna catch that one, okay? So, yeah, you are gonna miss some stocks, but you can only watch so many stocks, okay?
well, I mean, my question is that if you think it's a particularly a day to buy a stock, if you have 10 or 15 on the list, you think that it's going to be one that's going to break out that day?
Well, I don't have to think, I have to know. If it's doing it, if it's breaking out, it's breaking out, right? You don't have to try to predict that it's going to break out. You just wait for it to break out. That's why when you sort your list every morning, sort it by price percent change, and you'll catch them when they're breaking out. Okay? All right. Any other questions? Yes, sir.
Is dollar cost averaging part of your investing methodology? No. And do dividends represent any type of analysis or interpretation of a stock?
No. Typical growth stocks won't pay dividends. There are some that do, but usually they're reinvesting their money back into the company. Okay, yes, sir.
Do you follow your volume rules when you buy? So, for example, tomorrow you notice price movement. Are you gonna, you personally, gonna tune into those volume rules?
Oh yeah, absolutely.
So you'll only buy on volume.
Price and volume, yeah.
Okay.
When now ultimately, if all things being equal, price is going to trump volume. Ideally, when a stock goes through a buy point, you want it backed by strong volume. Okay. We say you want the volume to be at least 40% greater than its average. There's wiggle room in that. Okay. Okay. Any questions? Yes, ma'am.
If there's a stock I'm interested in, and I buy your digital,
Yeah.
can I enter it into your digital thing and it'll do a screening on it?
Here's what you can do. Okay, if anytime you find a stock on Kramer, you're watching Fox Business and you want to run it by IVD, you get access to this. This is called the stock checkup. It's on investors.com, okay? You put in the ticker symbol and we're going to rate your stock based on something called a composite rating. The composite rating takes into account all the fundamentals and the technicals, and it gives you one score. It's on a scale of 1 through 99, 1 being the weakest, 99 being the strongest. So if your stock has a 63, what are you going to do with it? What if it has a 93? Interesting, right? Yeah. Now, if it has, no, you won't buy it, but you put it on, maybe put it on your watch list, and you're going to use the chart to help you time your buys. Just because the stock is a 99 doesn't mean it's the right time to buy it, because maybe it's extended, right? Okay? Now, in addition to that, he's also going to tell you the 5 best ideas within that same group. A lot of times, when we're in the right neighborhood, we're just at the wrong house. He's going to point you to the right house, okay?
And does your E version give you everything that's in the print?
It's an exact copy of the paper, looks just like the paper. In addition to that, you get access to investors.com, where you have a stock checkup, you have a website. There's a ton of other features that I didn't cover, but take the product training and I'll be more than happy to cover them in the product training, okay?
Thanks.
Okay, so if you want to take advantage, please, if you don't have a subscription, give it a try for 2 months. If you don't like it, I'll refund your $28.95 back to your credit card. It's what we call a more than money back guarantee, right? Keep the book, keep the workshop ticket, take the training session, and cancel your subscription. You made out pretty good, okay? If you want to renew, please renew tonight because you get discounts, you get all kinds of free stuff. You're automatically enrolled in the meter program, and you get access to the product training unlimited for the life of your subscription. If there are no other questions, thank you.
Thank you.
Thank you. I'd like to thank you all for coming tonight.
Funding for Simsbury Community Television is provided in part by contributions from viewers like you. Thank you.